Talk to Ashok Leyland now. The company posted a solid set of Q2 earnings, clocking in a beat on all parameters. The revenues jumped 85%, margins expanded to 6.5% versus 3% last year, and brokerages have upgraded the stock. Gopal Mahadevan, the CFO and Whole Time Director at Ashok Leyland, joins us now. Mr. Mahadevan, it was a very good set of numbers. Thanks a lot for joining in on the show. But this is also on the back of a low base last year. So just want to talk about what the steady state of growth is for the commercial vehicle business in the second half of the year.
I'll put it this way. On an annualized basis, I think the research reports that all of us are getting show that there'll be about 22 to 24%. And I think there is still a lot of growth left in the commercial vehicle industry. Simply because what has happened is after 2019, the industry was a little flattish, and after that, it has degrown severely. Whereas the economy has started to grow. I mean, India is one of the higher growth or highest growth economy that the world is looking for. And more importantly, you're seeing a lot of infrastructure spend that the government is putting in, right? So we have seen real estate actually coming back, some of the commodity sector coming back, road building, infrastructure going up. So, this requires a lot of commercial vehicle support, in this growth. It's a direct outcome. The second one is the pent-up demand itself, which I mentioned about, which I won't repeat. From our perspective, if you look at the growth, like you rightly said, we're very satisfied with the growth in the current quarter, not just merely because of the 6.5% EBITDA that we posted, which is possibly one of the higher ones, but also because we gained market share by nearly 9%. So that was not based on industry growth; it was based on our market share growth. So our share of the market is now, for the third quarter in a row, is about 30%. The second part of it is the growth in the market share has been pan-India, which means we have grown in all the zones, north, east, west, central, and south, which again has been, which kind of exemplifies two things. The Avatar range of products has been very well received for their robustness, for their mileage, driver comfort, and total cost of ownership. So the feedback on the vehicle has been truly very positive. And that has also helped, but that has been a pull from the customer, if I may say so. And I think the initiative that the company has taken in kind of refreshing the network has also paid off.
Second quarter volume growth was 64.5% year on year. You're saying on a steady state, industry can grow 20 to 25% for the full year, and for next year, FY24?
FY24, we'll have to wait and watch how FY23 pans out. But I believe that, like I mentioned, that there is enough steam left in the, the commercial vehicle industry to grow in 24 as well. And if it does happen, I mean, I'm not very aggressive. We are not normally very aggressive or forward-looking. But if you see, a number of reports also state that the previous high of, 394,000 units possibly will get surpassed in FY23-24.
Right, sir, but I need to probe you a little bit more. Do you see your operational performance improve from year on? For the last quarter, you did around 6.5%. Is it possible that you have your eyes set, say, on moving towards double-digit margins?
Okay, let me put it this way. Instead of talking about second half, let me tell you what we are what we would want to see in the medium term, okay, over the next 1 year, 2 years, etc. We would want to get into double-digit margins, that's for sure. And I think it's possible if demand continues, if the GDP continues to grow, if there are no major shocks in the global economy, no major wars which shut down the world, India continues to grow, and commodities, reach saner levels. I think it had gone very high, and we are finding that commodity prices are coming down. And the more important thing is, if the industry gets into the mode of value selling, which means sell to a customer based on the features of the product and the capability of your service, instead of just discounting the product, the industry will actually move to a growth, not only a growth phase, but a profitable growth phase, which is exactly what we are attempting here in Leyland. We have been raising prices in Q1. We have done that in Q2. We have done that even very recently in Q3 as well. We are trying a bit to kind of ensure that while prices have to be raised in tandem with the cost of the product going up, we also are providing services and offerings which delights the customer.
You are sounding very optimistic. So you were telling Nigel that perhaps double-digit margins is possible by FY24. You want to take that a bit forward? I mean, are we looking at that as a possibility in FY23 itself, given the way the economy and the industry is panning out?
I don't know. I don't want to give a forward-looking statement now. FY23 seems very tough. But let us see. I mean, I would say that definitely, like I mentioned to you, I'll repeat it, and to you and for the benefit of your viewers, over the next maybe 1 or 2 years, we would certainly want to get into double-digit margins. The faster, the better.
Okay, so over the next 1 to 2 years, double-digit margins coming in from Ashok Leyland. That's the big headline perhaps our viewers would want to respond to. But can you tell us about the nature of the orders coming through between MHCVs, LCVs, tippers, multi-axle vehicles? You did mention that infrastructure spend is picking up, but where are you seeing orders coming in from? And also, are these for the existing infrastructure orders or are orders coming in for fresh projects? Just trying to understand whether there's a pickup in the Capex cycle.
Yeah, you see, what is happening is there is growth across the industry. You're seeing it in tractor trailer, multi-axle vehicles. Tippers have, suddenly has a huge demand and then flats out a bit and again then starts because tipper is directly related to infrastructure, right? Now, what has happened over the industry has been that there has been, like you rightly mentioned, there has been a pent-up demand that has happened. See, after FY18-19, there has not been any growth at all in 1920. And then from 2021 onwards, you had COVID. And then last year, the demand started to slowly come in. And what we believe at the moment, a lot of things we're just kind of piecing together the various components of the image that we see, is that we had the axle load norms revised about 3 years ago, right? 4 years ago. And we believe that the additional capacity that was created because of axle load norms is slowly waning out, and we don't have that additional capacity now. Finally, I would also say one more thing. I think ESG has become very important. As much as the world is moving towards EV, we must also remember that BS6 in terms of pollution is significantly lower than a BS4 or a BS3 or a BS2. So as people are looking at greener vehicles, not only will the demand for EVs start to slowly go up, we will also see that there is a shift from the BS1 and the BS2 vehicles moving in quickly to BS6, because that's what end customers would want. We believe that this is a confluence of all of what, I tried to kind of put together for you.
Mr. Mahadevan, is the problem of discounting to gain market share behind? You did mention that you want to do what you describe as value selling. So, and you've been raising prices. The industry phenomenon of discounting, is that also behind us broadly?
Unfortunately, the discounting continues. I mean, it's not come off, but it's kind of flattened. It's very difficult to put a percentage because it depends whether the pricing. See, it all depends on the geography. It depends on the type of vehicle, whether it's an ICV or it's a 49-tonner. Typically, I'll tell you, in this industry, the rule is the larger the tonnage of the vehicle, the better is the margins. Okay, so I think the challenge is actually in the ICV segment, where the margins are lower. And surprisingly, I'll tell you, but after that, when you get into light commercial vehicles, the margins are significantly better again. So this whole MHCV bit is actually the margins start to deplete as you get into the ICV segment. But having said that, what we do, and I have been mentioning this to you as well over the past few years, what we look at Leyland is the net price realization. So we keep raising the prices and we see on a net basis, are we improving ourselves or not? And over the last few quarters, we have been able to achieve that. And we will continue to pursue that strategy. Ultimately now, this is not like a car. This is an industrial product. It's a commercial product. What the customer today is looking at is not just the initial price. They are looking at the total cost of ownership. What is the quality and the ability of the vehicle that we are buying? What is the network and the service capabilities? How are the relationship with the dealers? How are the dealers treating the customers? So there's a whole complex, range of catalysts that actually drive a sale. So and what are the solutions that are coming out? Today, the vehicles are far more intelligent than what they were about even 3-4 years ago. So there's a confluence of factors that actually drive, the purchase of a vehicle, and we are trying to understand this much better and not just focusing on, let me discount it a little more and sell it, because that is not going to hold as a long-term strategy.
Well, Mr. Mahadevan, given that demand is very, very strong, would you look at raising your Capex guidance? I think earlier you had guided for around 750 crores this year. What's the update?
See, for the year, I can share with you that we had initially mentioned that we would have a capex of about 750 crores. We are actually possibly looking at a capex of only about 600 crores. The capex for the first 2 quarters put together is only about 214 crores. We have sufficient capacity. What we are working on is, instead of putting in raw capex, what we are trying to do is to improve productivity and then realigning manufacturing. There's a lot of work that our manufacturing guys are doing at the back end to actually improve the throughput. So we are going to do that. At the same time, let me assure you that we are not going to lag behind in capex. If we need to put in the capex, we will do that. But this will happen in stages. It won't be a greenfield or a brownfield. It will be more and more of balancing capex that we need to do to enhance, debottleneck the manufacturing facilities as we move forward.
Okay, Mr. Mahadevan, always great speaking to you. Thanks a lot for giving us some important numbers and all the best for the second half of the year. That's Ashok Leyland, very good numbers, and the management saying that they hope to do double-digit margins by FY24, and they are also looking at 22 to 24% growth for the commercial vehicle industry this year. Demand has been very strong. We'll pose all of these questions to our next guest. Prakash Diwan joins in on the other side for some stock talk. Keep it with CNBC TV18.